You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, the Options Bootcamp drill instructors will break it all down for you. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors.
All right, everybody. That music means we are back once again. Part 2 of our Options Bootcamp Double Pro Extravaganza. Of course, my name is Mark Longo from theoptionsinsider.com, as well as, of course, from the network upon so many of you are binging these days. If you're one of our many, many thousands upon tens of thousands of on-demand listeners, you like what you hear, all I ask is that you continue to rate and review it out there so more folks can continue to discover the show every day, just like Benzie did here. I like that. Benzie. Benzie says, I've learned quite a bit from these guys. You should too. Subscribe and start listening today. Well, thanks for that plug there, Benzie. Of course, if you want to go above and beyond, you want to join us live like a lot of our pro members are doing right now, either in the chat or afterwards on our pro podcast feed. You get early access to this episode 2 here of Options Bootcamp. Everyone else has to wait a week. Of course, you want to get access to our exclusive pro Q&A sessions. Got none other than Mr. Tony Saliba joining us tomorrow to answer all of your questions. The original options market wizard himself. He'll be in the hot seat tomorrow. Of course, options oddities, everything else that we do here. Giveaways. We just gave away our pro trading crate earlier this week. A lot of great stuff. Where do you go to learn more? Get part of all the action. Theoptionsinsider.com/pro. If you're cool, you can also go to /secret club. And let's see who's joining us today on this most secretive of shows. Once again, what a record. Nearly a decade now, we've been joined by none other than the black-hatted one himself, Mr. Dan Passarelli from Market Taker Mentoring. Mr. P, welcome back to the show, sir. You recovered from that trading floor tail extravaganza.
Oh, man, you know what? We have got to do another one of those, like a part 2 and maybe even a part 3. That was really fun.
That was pretty fun. Yeah, you threw out that horse. You started getting me into all sorts. Wait, the horse. We didn't talk about the O'Hare trade or any of the kind of good stuff that people used to have. Lots of good Texas hedges. What is that? All sorts of goodness. Yes, we could regale you with tales for days. Instead, let's have you guys regale us with some questions. It is time for the mail call.
Mail call. Time to look at questions submitted by our listeners.
All right, everybody, welcome to the mail call, the portion of the show where we take your questions from all comers here left and right. We also pay off some of the questions we've asked you. Last episode, or I should say 2 episodes ago now, we asked you guys, hey, markets were kind of in the red. They're a little bit green today, but mostly have been in the red for the better part of the last week or so. We asked you, we're back in the red in the S and SPY. How are you positioning in your broad market portfolio right now? I gave you 4 choices. You're still long SPY/SPX. You're long SPY or SPX, but with the put or some other hedge. You're in cash, waiting to do a little BTFD in, or you're into or moving to crypto. And nearly 36%, 35.8% of you said you're in cash, waiting to do a little BTFD in. You're still long SPY or SPX. You're kind of just hoping to ride this out. 32.8%. In SPY or S, but with the put or some other hedge was 25.4%. And only 6% say you're into or moving to crypto. So not a lot of love for crypto there. This week, we're asking you, saying, the Fed, Ukraine, and inflation have conspired to keep options volume relatively high in 2022, but the options market traded nearly 10 billion contracts last year. Can we possibly beat that total in 2022, or is that just too much volume? Gave you two choices, made it easy this week. Yes, we're going to hit more than 10 billion this year, or no, we won't. So Dan, what are your thoughts first off on the fact that 36% of our audience is in cash right now, waiting to be TFD? And then B, do you have a vote in our more or less than 10 billion contracts in 2022 poll?
I think it's interesting that 36% of our folks are in cash, just waiting it out. That's a little significant. That's more than a third of our listeners. And our listeners are the smartest out there, right? So, yeah, that's a little telling. As far as the other poll, where did that go again now? What one was that again now?
Well, we trade more than 10 billion contracts this year. That was pretty much the level from last year, which was a record level. Will we beat that or not this year, sir?
I'm gonna. It doesn't make any sense, but I'm gonna fade it. I'm gonna say no, we don't. And that's because for some reason, people love trading options only when the market is going up, when in fact, it can be so much better when you have a market like we're in now, where you got some juicy, volatility in the options, and you get some ups and downs, and you get some movement. So you would think there would be more trading this year, but historically, I just haven't seen it work that way. So I'm going to say we trade less than last year, unfortunately.
Dan, fading the retail tsunami out there. Well, there's that old saying, right? Options love a bull market. So there are some folks that are in that camp. Right now, our audience is not among them, though. 61.5% saying, yes, we're going to beat it. More than 10 billion this year. No, only 38.5%. I'm assuming, Dan, in your heart of hearts, you hope you're wrong, though. You want more paper out there.
Oh, yeah. Yeah, exactly. I totally hope I'm wrong.
All right. Speaking of Dan's heart of hearts, sometimes we ask him to open the kimono to his mentees, his members' hearts of hearts. What do they have on the brain? What are some of the cool, interesting, bleeding edge, compelling questions that they are asking him that he wants to share in his MTM Question of the week, sir?
Well, this is a question that I got recently, and of course it is telling also, and it makes a lot of sense. I guess I was kind of waiting for this question to come along, but because Greeks is sort of my known for, my thing. I had somebody email me and say, "Hey, are we going to start, needing to know about Roe?" And the answer is yes. Like, Roe is becoming a thing now. And like right now, actually, it's really more with longer term options. And to be fair, like a lot of our traders and myself stick with shorter term options where it matters less. But, the prospect of a 50 basis point move or a 75 basis point move, like that can affect your leaps or 6-month options even quite a bit. So it's time to bone up on that a little bit.
I've often said we'll know when the rates are becoming a factor again when we start getting those Roe questions, right? And we have been getting those for at least the last 6 months, if not longer. So yeah, Roe potentially a factor again, Dan. I've often called it the redheaded stepchild of the Greeks, because you don't really have to care about it all too often. If you're hanging out in the weeklies like a lot of our listeners are, Roe's never really going to be a big factor for you. But yeah, it's certainly out there. And these days, got the Fed on the brain and rates are creeping up, Roe suddenly becomes more of a factor. Let's go out here to DCAMB36. DCAMB36 says, what does Mark mean when he says, quote, harvesting the old risk premium? Yes, I guess I do say that a lot. Sometimes these things just work your way into your verbiage, and you sometimes forget to define them, especially for a show like this. Remember, DCAM36 and everybody else who's confused by that, go back into some of our earlier episodes where we explain things like volatility. When we do that, listeners, we talk about two different types of volatility. There's the realized or historical volatility, which is the amount of vol, let's say in the S&P right now, the amount of vol the S&P has exhibited over whatever time frame you're looking at. Could be 10-day historical, could be 30-day historical, 2-year, whatever you're looking at. That's how much actual volatility has been exhibited over that period. You can measure that very precisely. Hindsight is always 20/20, right? You can see exactly how much vol has been exhibited. Now you have the other side of the volatility coin, which is implied volatility. And that's exactly what the name says. The level of volatility the market is implying for those options. Remember, market makers don't have crystal balls. They don't know for sure what's going to happen. So they have to guess. They have to imply, based on analysis of everything that's gone on in the past, what level they think the options are going to be trading at. And then they post their quotes, and then the customers come in. And if they're too low, they'll bid them up. If they're too high, they'll crush them down. And that's kind of how the market makers know that they're a little bit off. And so that's where implied vol is. And by definition, implied vol, except for certain crazy scenarios, is pretty much always going to be higher than realized volatility, because it has to be. You have to build in a bit of a fudge factor, right? You don't know. So historical vol could be 6% in the name. You're going to maybe price options at a 9, just because you need to build in a little bit of wiggle room for what's going on. So there's always going to be that difference between implied vol and realized or historical vol. And that's usually implied vol is above that. So when I say harvesting the risk premium, that's what that is. That's called the risk premium. The difference between the level of implied volatility and the historical or realized volatility, that is the risk premium, the premium you're taking or paying for either buying options or selling options out there. So if you're selling options, you are harvesting that risk premium. You're trying to sell the implied, and hopefully that's overpriced and you get to keep a good chunk of that. And so that's where that term comes from, harvesting the old risk premium. Mr. Dan, anything to add there on realized versus implied, sir?
I mean, I'll tell you what, that's what we spend a lot of our classes at Market Taker working on, because while it's usually not the most important thing in your trading, it is something that can give you an edge, give you edge, if you want to put it that way. And it is one of the most predictable things in trading, in my humble opinion. Whereas I don't know anybody who can just accurately predict where a stock is going to go. There's just, nobody knows this, right? Nobody can say, hey, tomorrow after earnings, the stock is going to be trading at 58. But I'll tell you what, I've trained my students who do our earnings class to do this. We can pinpoint where volatility is going to fall to within one volatility point, I'd say about a good 90% of the time. So that just gives you a little bit of it gives you a lot of an advantage when one of the factors that goes into the pricing of your options is something that's, I don't want to just say known, but kind of predictable.
So there you go. What was the name there? DCAM 36. Hopefully that clears things up for you. If you're still confused, check out again some of the earlier episodes of this program, or go check out our Volatility Views program. We get into all that kind of stuff in a lot of detail on that show. Let's go out to this one from and/or. I see what you're doing with your play of words there. AUR, but or. I like that. And/or. He or she says, I own a call spread in Twitter. It's the July 50-55 call spread. He said Musk is buying Twitter for $54.20. Does this mean that my option gets exercised on the long leg of $50 and the $55 short leg expired worthless? Should I cash out now with the underlying trading below $50 with a very small profit, or wait until Musk's buy offer goes through? What risks do I have here? Thanks, guys. All right, so a lot to unpack here. Twitter has obviously been very much in the news of late because of Mr. Musk's, of course, offer, or now accepted offer to buy Twitter. As we're talking right now on the show, listeners, it is below $49. It looks like it closed today, $48.87. And again, looks like it hit a high during all this frenzy back on the 25th of 51.70. Let's see. Looks like that's the near-term high out there. Yeah. So that's pretty much as high as it got. So it got inside of his range. He has the 50 double, the 50-55 vertical out there. So Mr. Dan, I'm sure some of your traders over there at MTM have been slinging a little bit of Twitter and all this Musk frenzy out here. What do you have to say for Mr. or Mrs. or who wants to know, should they bail on their July 50 double call spread, or should they wait for a little bit and see if they can get some value out of this thing? And also, how does it work if one leg is in the money and one kind of goes out worthless with this kind of corporate deal?
Man, when you said there's a lot to unpack, Mark, holy moly. So here's the thing. People make like careers, like they say there's riches in the niches. And one of the niches is to become an expert at trading options on takeover stocks, because there's a whole lot that can go wrong. There's a whole lot of things that a typical person just doesn't know because you've never seen it before. So there's a lot of risks. So first of all, the reason why Twitter's trading at a little below 49 probably has a lot to do with the fact that somebody thinks maybe it's not going to go through, because if you're holding the shares, you're going to get $54.20 a share from Elon Musk if it goes through, right? So there's like a risk discount factored in there. And you probably noticed that on the chart, as of a few days ago, once the offer was accepted, the stock has been pretty it hasn't really been moving much the past few days. And until something changes, the deal goes through or the deal doesn't go through or whatever, typically those stocks sort of just get stuck there, and historical volatility tends to fall into the single digits, and implied may as well. And then, when exactly is the X date? I'm not sure if we know when the X date is. If that's public, I haven't come across that, and I'm sorry if I did, but I don't think we know exactly when that X date is. And so what happens with the cash deal? Well, typically, but this is only typically, the any option that would expire after the X date just goes away. I think of it as they expire early. So if you've got a 54-day option and 3 days from now the deal closes, that 54-day option is a 3-day option. So any like extra time premium in it just gets sucked out the window. So there's a whole bunch of stuff here going on. I tell people with stuff like this, unless you're an expert, just sit it out. And if you have a profit on it, then it's never hurts to take that money and run, because unless you're an expert, there's definitely a lot of stuff you're missing.
Yeah, I did a little digging while Dan was talking. Because obviously the first advice we give everyone with these types of questions is go to the Options Clearing Corporation homepage. They're the ones who are going to determine if this stuff is official, what the settlement price is going to be, what's going to happen to your options. So go there, type in your ticker symbol or the name of your stock, and look for circulars. And I just did that while Dan was talking. There is no official information. They have stuff from like 2015 to 2019 to 2021, but nothing about this new deal. I also pulled up the data on it. Even from their own release, they say this is just expected to close sometime in 2022, obviously subject to the approval of Twitter stockholder. The board has approved it. I don't think the Twitter stockholders have approved it yet. So that's kind of why we're hanging out in this limbo. Also, regulatory approvals. We are in this weird kind of anti-big tech environment in Washington. So there could be a little bit of that hanging over this. These congressmen, they want to make their headlines. Busting up a Musk deal would certainly get them some time in front of the microphones down there in Congress. There's probably a little bit of that hanging out there as well. So right now, we have no more information for you here. Or in terms of this, if you're not comfortable waiting a little bit to see a little bit more clarification, you have till July, so you got some time. But if you keep waiting, some of that value will come out of that spread over time. So if you're not comfortable waiting, if you still got a little bit of a profit, you want to just maybe wash your hands of it, then close it out. If you're okay with a bit of a flyer, maybe you think something's going to happen, it's going to get approved between now and then, because you're right. If it does get approved between now and July, you should get that value of the difference between the two. So that's up to you, whether how much you put in this, how much of a position it is, you don't say, and how comfortable you are. It's going to be kind of an all or nothing thing. You're going to lose that money or you're going to make this profit. There's not much middle ground there. So as long as you're comfortable with that, this is kind of a speculative trade you made, and you're willing to take a bit of a flyer on this deal going through before your options expiration. This could happen a day after your expiration, and it won't matter for you. So it has to happen by then. So you want to wait a little longer, get a little bit more information, as long as you're comfortable losing some of that value in that spread, and then decide if you want to take it off, hit us up. Let us know what you think, because right now it's still kind of up in the air what's going to happen with this stock, and there is no information in terms of settlement prices or anything like that. Let's go here to Scott Somer, one of our regular listeners. He wants to know, he says, with SPX now, with every trading day expirations coming soon, what timetable are we looking at for SPY, QQQ, and IWM to follow? All these major index providers, they kind of have to go through that with their own index provider. It does seem like S&P folks are down. We saw it at SIBO. We saw it on CME now. They're down for daily expirations out there, which we have now. Monday, Tuesday, Wednesday, Thursday, Friday expirations for the E-mini options at the at the CME, and the S&P options over there at SIBO. Mr. Dan, have you traded any of these daily S&P options in any of these venues? And do you have any thoughts on when we might see the same thing from NASDAQ and Russell 2000, sir?
No, I mean, I have not traded any of the dailies, but I would think that it would catch on pretty quick, because liquidity begets liquidity. And so just adding more options to an already active name just creates more option trading, because of arbitrageurs, they hedge options off of other options. They keep the skew in line. And so especially with a name as active as SPX, it'll probably really catch on and be very successful, and the other ones will soon follow. So I wouldn't be surprised if, within 3 months of the date of the daily options in SPX, that we see them in all the major indexes.
All right, let's go here to, this is a longtime listener as well, Theodore Domzowski. He has, I guess, a warning that we could probably share with the rest of our listeners here. He wrote in to say, hey, I believe I'm getting scammed by someone pretending to be Larry McMillan. And he shared some screenshots with us here of an account that is clearly not Larry McMillan's account. It's both meant to look like him, it has his picture and everything, obviously, but it's not him. It was started in April of 2020. Obviously, he's been doing it a little bit longer than that. And he also shared some of his back and forth with this person, because this person was trying to aggressively get him to buy a product or something along those lines, that he was trying to quiz them and what they said in their books, and they were clearly didn't know. A bit of just a warning for you out there. If you're hanging out on FinTwit out there and someone is coming at you, could be someone you've heard of or read their book of, or maybe even someone on this network, and they're hitting you up aggressively, and it doesn't seem legit, doesn't seem true, you can reach out to us like they did. Chances are we can help you with that and say, hey, that's obviously not them. But also, just be smart out there. If someone's aggressively hitting you up and they're trying to DM you and everything else to try to buy something, and it doesn't seem right, doesn't seem like it's actually the person, it probably isn't. Mr. Dan, any thoughts here on these Twitter scammers going around pretending to be various options people, sir?
Yeah, I mean, I hate hearing stories like this. I mean, like to do stuff like this, it takes a whole bunch of work. Like, why don't you just work harder at your job and stop trying to scam people? Like, have a little self-respect over here, will you?
We won't get out of here on a scamming story. Got to be more positive than that. Let's get something a little bit better for the people. Let's go to this one. Let's go to Mark McGee. I like your name there, Mark. He says, I'm trying to learn more about calendars. They're pretty tricky. So far, I think I can handle the use case for the basic long calendar, but I've heard people talk about diagonals as well. When do you decide to make the switch between straight calendars and diagonals? Now, Dan, obviously, we've done episodes on time spreads in the past. I've often referred to them as the options 201 or maybe even the 301. When you're dealing with multiple expiration dates, that's when people start to get a little bit nervous, a little bit skittish. They get a little bit overwhelmed by these. So, Mr. Dan, if Mr. Mark was coming to one of your mentee classes and he says, when should I choose between a calendar, a straight calendar, and a diagonal, sir? What would you tell him?
Well, first thing first, when you say they're pretty tricky, you're right. Like, they are, a lot of people don't give them their full due. Like, there's a lot more going on than there is with, say, a vertical spread. The Greeks have, they're very nuanced with calendars and diagonals. But as far as when to decide between which, a straight calendar a lot of the times is a direction neutral strategy. You put it on at the money and hope the stock stays around that shared strike price. Whereas with a diagonal, it's typically there's typically a delta to it. You can set up diagonals actually a whole bunch of different ways, but the most common one is like the poor man's covered call, where you buy a long-term in the money call and sell a short-term out of the money call because you think the stock's going to go up. It's kind of like a covered call, but not exactly. So the directional bias is one thing. I mean, you can use calendars with the directional bias, and they can be really nice as well. But yeah, I mean, there's a lot of nuance there. What I would do is maybe paper trade them or really kind of bone up on them, before jumping into it. Because they're powerful strategies as well. You can use the term structure of volatility to really get a statistically dominant trade out of it to get an edge. So, keep on this path you're on, Mark McGee.
Ah, yes. Time spreads. Maybe it's time to revisit them. Whenever we talk about time spreads, Dan, it kind of just opens the floodgates to legions of questions. We'll probably have more of these. You listeners can go back into the archives. Don't have to go back that far. We've talked about time spreads fairly recently on the show, within the last year or two. So you can go check those out. If you have questions, hit us up. They are intriguing, sometimes intimidating spreads. Your basic calendar, you go out to 2 months out, buy the at-the-money contract, sell the front month at-the-money contract. So it's a straight at-the-money type trade. You want things to hang out there for a while because you're short that front month contract. And that's usually kind of the basis. And also, as Dan mentioned, trying to take advantage of usually a bit of a discrepancy in the term structure. Hopefully you're buying the cheaper vol month and selling the more expensive vol month. Calendars, you're right. They get a little bit, or diagonals, I should say, they get a little bit more tricky. And I think Dan's example of that basic, what Brian calls the fig leaf, what some people call the synthetic covered call, buying a longer term in the money call, selling a front month or even a weekly out of the money call against, is a good starter way to approach diagonals because it's pretty straightforward. You can usually wrap your head around that. Mr. Dan, let me ask you this before we head out of here. I'm curious. Have you ever done calendars the other way, the short calendars where you're selling the farther out contract and buying the near dated one, sir?
Those margin-wise, those are a little bit trickier in a retail account because the way your broker will look at it is, well, when the short-term option expires, then you're left with like a naked short call, and they're going to margin you that way. So I don't know. I think you can usually find a better way to trade whatever you're trying to accomplish anyway. Maybe just buying a straddle or backspread or strangle or something. So yeah, I personally don't do a lot of those myself.
Yeah, those are weird ones. I want to just throw it out there because I know they are very esoteric, and you're right. Margin. Very challenging from those, particularly for retail traders. Mr. Dan, if folks have questions like this, they want to hit you up, see what's going on in the land of MTM, where should they go? What should they do? Maybe they want to retreat with you, sir.
Yeah, so make your way on over to markettaker.com. Market as in stock market, taker as in take what is rightfully yours, 2 T's in a row, and hit us up. We actually have, you mentioned our retreat. We're not really publicizing that much, but we actually have some spots. It's going to be in Sonoma, June 2nd, 3rd, and 4th. It's an in-person event. And it is a fantastic and wonderful event. We've got lots of surprises for folks. If you want to join me in person, make your way on over to our website and, just send me a message and I'll be glad to tell you all about it.
And Dan, nice guy that he is, he has resurrected the Condor just for me. So I can have a first-class experience, a supersonic flight. I don't have to waste much time. Get right out there to the retreat. Dan, very nice, very kind of you, sir. I can't thank you enough, sir.
Oh, of course.
I expect no less there, of course. As you're hearing this, listeners, I'm actually down in Texas at the Options Industry Conference. So it should be some fun content and info coming at you from that event, hitting the network sometime soon. And we'll be back again next week at our usual bat time, our usual bat channel, another episode of Options Boot Camp. Stay safe out there, everybody.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.